So let's say I'm going to take my $100,000 and I'm going to put $3,000 of it into alternatives. Which remember, these are usually illiquid, but in this case they're not. So $3,000 into not alternatives, but cryptocurrency, right? So I'm going to keep the other $97,000. I can't read that color. $97,000 over here. So let's say in the worst case scenario, this goes to zero, right? And let's say the market goes up, we'll call it 10%, right? So 10% of 97,000 is 9,700, right? So if you add that up, it's $106,700 plus zero means my account is $106,700. I went up roughly 7%. Okay, 7% when the market goes up 10 is not that. It's not that bad. You're happy, right? Your account went up 7%. You're probably upset because you didn't. You could have made another $300 or so, right? And your account could have gone up a lot more, but it didn't. You lost 3,000 here. You could have made more money over here, right? So let's say, on the other hand, that this triples, right? So you get the 3x, and this goes to $9,000. And let's say at the same time that this actually goes down 10%, right? So this becomes $87,300. This goes down 10%. You add that to the 9,000, and you get 96,300, right? So the market went down 10%, and you lost $700 total. Well, that's not bad either, right? It'd be great if the market goes down 10% and you only lose $700. That would be kind of cool. So that's the risk potentially you take. Now, on the other hand, let's say you did not invest in this at all, and the market went down 10%. That means you had $100,000 here. Market goes down 10,000, and you're left with 90, right? In our other scenario, we had 96,300, I believe. So investing here, and it goes up 3%. Market went down 10, you're actually up $6,300, right? So what it does, again, is it kind of normalizes. It gives you something that's non-correlated that gives you that opportunity. If the worst case scenario is the rest of the market goes way up and this goes to zero and you lose $3,000, well, you're out a grand total of 3%. But look how easy it is. Let's say, and that's, Bitcoin and Ether going to zero. If you think Bitcoin and Ether are going to zero, then yeah, you shouldn't allocate anything to it. But it has that chance. But if I don't allocate anything to cryptocurrencies, right, and I have my $100,000 to invest, what has to happen for me to lose that same $3,000? All I need is a 3% drop in the value of my market portfolio. 3% drops happen all the time. That's not even a whole lot. That could be a couple days, right? And that would get me to $97,000. So if the absolute worst happens in cryptocurrency, which is cryptocurrencies are really worthless, it would be the equivalent of me losing 3%, which could just be a bad day or two, probably a bad couple days in the market. But it also gives me the opportunity to normalize or equalize my portfolio a little bit, right? So again, if that $3,000 or 3% that I allocate goes 3x, well, now I have 9,000, right? It's not enough to write home about. It's not like, man, I'm so glad I got into this. I'm a millionaire from my cryptocurrency investments. But what you're doing is you're trying to normalize and have non-correlated assets. So when when your market investments go down, this might go up. It might stay the same. It might go down a little bit less. Who knows? You're not doing it to try to get super rich. You're doing it because it's just part of how you should allocate and diversify your investment portfolio potentially. Again, say it again, I'm not giving advice. The other nice thing about using this as part of your alt pool, right? Because let's say you're allocating a total of 10% to alts, right? So you could put $7,000 in real estate potentially and $3,000 in crypto, right? This is highly illiquid, right? This is extremely liquid. So at any point you can go onto whatever exchange or MetaMask, IDEX, whatever, and sell this if you really needed the money. You don't have to break into your market. You don't have to break into your safe money. You don't have to break into your illiquid REITs or anything. You have actually an alt that is highly liquid, that you can get to your money pretty quickly. And in some cases, you can actually pay using your cryptocurrency. But that's how I would look at crypto as an asset class. A lot of institutions are looking at crypto as an asset class, partially because they see the potential value, but they're not doing it to turn their foundation or their endowment or anything from, $1 million endowment to $1 billion endowment. They're just looking at it as a way to have a non-correlated asset. It's similar to why you might invest in something like, again, real estate or gold. Any big institution is going to have alternative investments like real estate, private equity, hedge funds, gold, something so that when they look across the risk profile of their overall investment portfolio, hopefully there's not one or two assets that can go down and bring everything down with them. They are extremely diverse, and they have a lot of non-correlation between them. So institutions are looking at crypto as, yes, potential growth, but more than anything as non-correlation. As an individual, the tough part is you're not quite sure. You see losing $3,000 is a lot. Oh my gosh, at 3% of my portfolio. But in the grand scheme of things, is it really that much? Is it really that bad to allocate 3% to some highly liquid alternative asset class? That's something for you and your advisor and your family and everything to decide. But just going through the exercise, seeing how cryptocurrencies have kind of come of age. There's exchanges. They've grown in value. There's institutions getting involved. The question is, have they passed the point where they're not going to go to zero? Even if you think they're going to go to zero, even if they might go to zero, right? There's that chance, of course, that they'll go to zero. The most you lose if you allocated 3% is 3%. Well, you can lose 3% in the market any day. Again, I'm not giving the financial advice. What I'm saying is what a lot of financial advisors actually won't say is, I would allocate some of my assets to cryptocurrency, and then the way I would look at it, if I'm going to do that, is it's an alternative asset class that actually has liquidity. So you take away the illiquid part of the alternative asset class, and you say, okay, this is liquid. Now you have to go find potentially a financial advisor who understands it. You have to find some tools to help you with things like taxes. You have to work on your security, your wallet security, all of that. So it actually takes some more time. You have to find someone who understands it. However, and I'll put some links in the notes to financial advisors I know of that actually understand this. But that's how I would look at cryptocurrency as an alternative investment as part of your portfolio. Again, whether you're an individual or if you're an institution. If you're an institution, you might want to look at cryptocurrency as an asset class. Again, just as a way to take out some of that correlation a lot of your other asset classes have. But if you're an institution, you know that already. As an individual investor, again, I'm not giving you the advice. This is just how I would look at cryptocurrency as an asset class. The other nice thing to note is there are firms that are coming out that are getting funded that are providing some of the rails we see on other investments, on market investments and real estate and such. In the traditional finance world, we have these abilities to hedge and limit our downside and everything. There are companies like Drawbridge Lending is one, BlockFi is one, that give you the ability to actually create some growth on your cryptocurrency and limit some of your downside risks. So now you can go, oh, okay, I want to participate in some of the upside, I want to limit my downside, and now I can do that. And that is maturing even more in the space. So this video, again, I want to talk about cryptocurrency as an asset class because that's very important as it differs a little bit from just decentralized finance or DeFi. It is just potentially its own asset class. Again, I'm not advocating that you do it. I'm not giving that financial advice. I just want to talk about how we would look at it as a financial advisor and how other financial advisors might want to look at it. Again, I hope you subscribe to our channel here on YouTube so you can see more videos. On the web, we're at interaxis.io. On Twitter, at interaxis8, the number 8. Let us know if there are any other videos you want to see, and we'll see you at the next one.